Hi everybody, this is Alan Ellman, the Blue Collar Investor, and welcome to this video titled Comparing Covered Call Writing and Selling Cash Secured Puts. Today we're going to look at the similarities and differences between these two low-risk option selling strategies. Many people consider these strategies precisely the same, but I'm here to give you some information that may change your mind about that. Okay, so let's first start off by defining the two strategies. First, covered call writing. Well, this is a strategy where we first purchase a stock or an exchange traded fund. Now, once we purchase the security and we are in a covered or protected position, we are then free to sell the option. And we sell some unknown person the right but not the obligation to buy our shares from us at the strike price by the expiration date. So we set a price that we're willing to sell our shares for, and we also set a time when the contract will expire. Now, in return for undertaking this obligation, we are paid a cash premium, which is generated into our brokerage account immediately, and that is covered call writing. Now, let's have a look at selling cash secured puts. Here we sell a put option which allows the buyer of that option the right, but not the obligation, to sell their shares to us at the strike price by the expiration date. And of course, we as put sellers set both of those parameters up, how much we're willing to pay for the shares and when the contract will expire. Now, simultaneously to selling the put option, we also are required to put a certain amount of cash into the brokerage account so that if this future stock transaction actually takes place, the cash will be there to purchase the stocks. And the amount of cash we put in is the strike price minus the put premium times the number of shares and contracts. Now, in return for undertaking this obligation, just like with covered call writing, we are paid a cash premium that's generated into our brokerage account instantaneously. So that's the definition of the two strategies. Now let's have a look at the similarities first. And the main similarity that people talk about all the time are the profit and loss graphs or the risk-reward profiles. They are precisely the same. And that's why a lot of people mistakenly say the two strategies are precisely the same. They are very similar, but not precisely the same. And you could see from these graphs that there is a maximum profit level, as you could see from the arrow towards the top, and nearly an unlimited downside. But that's a little bit deceiving because it assumes that no action will be taken if the price of the stock starts declining, which is ridiculous. With whatever strategy you're using, you must be prepared to take action. So the first similarity is the profit and loss graphs. Now here are some more similarities. Both of these strategies leverage an underlying stock or ETF to generate cash flow. That is the main reason people sell options, to generate a regular cash flow. The screening process involved in determining which underlying securities to use is precisely the same as are the watch lists. So if you're a covered call writer, you're going to have the same watch list as someone who's selling cash secured puts based on your screening criteria. So if you're using both strategies, it's even better because you only have to screen one time, and now you have a watch list that you could use for either strategy. Also, the skill set required to use covered call writing or selling cash secured puts in your brokerage account is the same three required skills. Number one, learning how to master what stock to select as the underlying security. Number two, learning which option to select. Not all options are the same. There are certain options that do better in bull markets and certain options that do better in bear markets. That's something we need to learn and master. And finally, position management. What do we do after we enter our trade if the trade turns against us? Stock price starts declining. What do we do if it turns out much better than we anticipated? Stock price starts going way up. What do we do if there's a dividend distribution and we don't want our shares sold early? What do we do if the strike is in the money as expiration approaches and we don't want the contract assigned? In other words, we don't want to sell our shares or we don't want to buy the shares. There's action we could take for every possible situation, and that's something we need to know ahead of time, not after we enter the trade. Let's talk about some of the differences now between these two strategies, and let's start with dividends. Covered call writers own the underlying shares. Remember, that's step one in the process. So as share owners, covered call writers do collect the dividend distributions as long as the shares are owned on the ex-dividend date, whereas put sellers do not collect dividends. However, the put seller, because of put call parity, will generate a higher premium than the covered call writer. And that has to do with the fact that if there's an ex-dividend date prior to contract expiration, we know ahead of time that on the ex-dividend date, the value of that stock will go down by the dividend amount. So the calls then are worth less and the puts are worth more. So the fact that the covered call writer collects dividends can be basically taken away by the fact that the put seller is generating a higher premium. So it kind of negates the fact that the covered call writer does get the dividend. All right, let's look at some more differences now. The maximum profit. This is important. The covered call writer can generate a premium on the option plus share appreciation if an out-of-the-money strike was sold. Let me give you an example. You buy a stock at 48, sell the out-of-the-money 50 call option for $1.50. Well, if the price of the stock by contract expiration moves up to the 50 strike, you've generated $1.50 per share plus $2 per share on the sale of the stock from 48 to 50. That's $350 per contract. Two income streams in the same month with the same stock with the same cash investment. On the other hand, put sellers generate only premium. So in my eyes, covered call writing is a slightly more bullish strategy than selling cash secured puts. Let's look at another difference, the initial step. With covered call writing, the first step is to buy the shares. That's what makes the process covered or protected. We first own the shares before selling the call option. The first step in selling puts is to place an appropriate amount of cash into the brokerage account for a possible future stock transaction, also known as buying the shares from the put buyer. So we have to put in the premium, put premium from taken away from the strike price times the number of shares times the number of contracts. And that's the amount of cash our broker will require us to place into the brokerage account prior to selling the put. Another difference is your market outlook. In my eyes, covered call writing is appropriate in slightly bearish to bullish market conditions. The strike price, the type of stock we select, will dictate what we do based on the overall market assessment, based on chart technicals, and based on our personal risk tolerance. So we're more likely to sell an out-of-the-money call option if we're bullish on the overall market. Selling cash secured puts, since we're getting only put premium as our profit, is slightly bearish to neutral. So I tend to use covered call writing almost always when I'm bullish on the market and actually neutral as well. So I'll tend to go with selling cash secured puts when I'm more bearish on the market or if we're in a very volatile market environment. Another difference relates to self-directed IRAs. Covered call writing is almost universally accepted by most brokerages for sheltered accounts. Selling cash secured puts is allowed only by certain brokers. This has to do with the KYC rule or know your customer rule that brokerages are bound by, and they are being regulated by FINRA and by the SEC, and they have to make sure they don't put their clients into a strategy that they shouldn't be. And most brokers consider covered call writing more intuitive than selling cash secured puts, and that's why they permit covered call writing almost universally in sheltered accounts, but many do not allow selling puts in sheltered accounts. So that's another difference. Also, another difference is the level of trading approval required to use these strategies. This particular broker here has covered call writing as level 1 and selling puts as level 2. Now, once again, even though these strategies are so similar, the reason for the difference is that most brokers feel that retail investors will understand covered call writing a little bit quicker because it's more intuitive than selling cash secured puts. So to get approval to sell puts usually requires a little more effort on the part of retail investors to get that approval. Another difference, this is more rare, is early assignment. Covered call writing, it's really not an issue. If our shares are purchased early, we know our cost basis. We know what we paid for those shares. So it's really no big deal. For selling puts, if the price of the stock is dropping precipitously, we may not know that early assignment is taking place until notification, which may not happen until the next day. If we knew about it that day and the shares are put to us, we may want to sell them before the shares drop even further. So the fact that notification of a declining share price may not take place to the following day is one disadvantage of selling puts, but it's very, very rare that that will happen. But it's something that I want to make everybody out there aware of. Now here's another difference, the cost to close when the stock price declines. You have to think about this now because the value of the option will change based on the change in price of the underlying stock. This is known as delta. Now, for calls, the price of the option will decline when the price of the stock declines. It becomes worth less, so the cost to buy back that option that we originally sold will be lower if the price of the stock is going lower. But for puts, it's the opposite. The relationship between the put value and the stock price is inversely related. So as the price of the stock goes down, the value of the put goes up. So we're going to have to pay a lot more money to buy back that put if the share price declines, which means that we have to be prepared with more cash in our brokerage account to close an option position when we're selling puts because of that fact that delta is inversely related to the price of the stock for puts. Now let's talk about some advantages of put selling. And when we sell an out-of-the-money cash secured put in a bearish environment, that means that we're not buying the stock right away and then perhaps selling an in-the-money strike, but we're allowing us to buy the stock at a discount if the price of the stock dips below the put strike price. Then we're purchasing the stock at a discount, and maybe we'll get it for, let's say, 5% lower than when we first entered the put trade. Once those shares are put to us, we can then sell an in-the-money strike, giving us additional downside protection. So in many cases, stock price can drop by 10% over the 2-month time frame, and we still will not have lost money. So that's an additional advantage of selling puts before entering a covered call trade, is that additional downside protection. Another great advantage of put selling is that it allows us to buy a stock at a discount in lieu of setting a limit order. So let's say, for example, there's a stock that's trading at 75 and we love it, but we'd like to get it a little bit lower in price, let's say 71. What we could do is sell the 73 out of the money put strike for $2, and if it's exercised, then we purchase the share at a cost basis of 71. If not, if the price of the stock remains above the 73 strike, then we get paid approximately 3% for the 1 month not to buy the stock. So it's a great, great way to buy a stock at a discount instead of setting a limit order, as long as we're willing to buy the shares in 100 share increments, which is the equivalent of one options contract. So there you have it, folks. Two strategies that a lot of people think are exactly the same, but I hope I've given you some food for thought that there are certain nuances that make these strategies slightly different. They are similar, but they're not precisely the same. So thank you all for taking the time to watch this video. Hope you enjoyed it. And more importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.